Hey everyone, it's Imran back again with another macro options spotlight. Okay, global stocks were lower yesterday. Europe was the worst hit, down pretty hard, 1.5% plus. US did finish off its lows though. We saw the US House passing the debt ceiling bill, sending it over to the Senate, which should be hopefully going through there today. China also stabilizing a bit. Their Caixin survey, manufacturing PMI came out. And that showed expansion, which is contradictory to what we saw from the weaker numbers from the officials the day before. So that kind of lent a little bit of support to China. Commodities were mixed. We had the likes of precious metals rallying a bit. We had uranium up, but then energy, oil, nat gas all a bit lower. We had the dollar firm near its local highs, about that 104.5 kind of area on DXY. Treasuries will also bid into month end with TLT up another percent. And then looking at sectors, we had ARC once again outperforming, up nearly 2%. I mean, that's been quite consistently outperforming now, taking the lead off what the Nasdaq's been doing. But it's quite an interesting area of resistance, this 40.5 area, which if it was to breach, then it leaves quite a lot of room for upside acceleration in ARC. And I suspect it's going to need a crypto rally to really make that thing go. But it is teetering on that level. Looking over other things, we've got implied vols drifting slightly in the US. European implies did catch up though pretty sharp. We see 2 vol point pop there. And that's actually taken short end implieds at 16 handle, which is 2 vols above the S&P. So we haven't seen European front end vols 2 vols above S&P since March. So that's interesting to see. And you look, the realize is kind of similar as well. A lot of carry being neutralized here. So not as much green as what we're used to seeing maybe in Europe there, as we're starting to see bigger swings. Looking over at commodity vol, we also saw a pop across the energy space. In commodities, up 1 to 2 vols as well. And then outside of that, I'd say interesting to see bond vols continue to slide. Over 1 vol point drop in treasuries there, taking it back to a 15 handle. And that's nearly 2 vols lower on the week. But it's also 2 vols lower in HYG, which is a much lower vol level. And that's basically on a 6 handle now, really starting to get beaten up quite hard, the HYG vol, as this thing just kind of sits at either between 74 and 75 for as long as I can remember, pretty much is where HYG has been. And then lastly, looking at skew, a little bit of a drift. It is down quite a bit on the week in the US, skew coming down a good couple of vols, but we are seeing European skew catch a bid. And you can see that more clearly on our vol and skew matrix here. It's getting quite extreme now. DAX skew has popped. Eurostox and DAX skew are kind of a bit of an outlier here as they're pushing towards the right of the curve and leaving everything behind. So, Europe has had a reasonable swing lower. Clearly, China has been driving a lot of that. Question is that overdone now? Well, we're certainly starting to see a fair amount of fear being priced back into the skew in European indices. All right, what else are we looking at? So liquidity drain coming. I mean, it's not new. We've been talking about this for a while. But basically, now that the debt ceiling's been put to the Senate, it does look like the Treasury is going to have the all clear to start issuing again T-bills, Treasury bonds, etc. And this is what the liquidity trackers have been losing sleep about. So TS Lombard Research House, they project that the S&P, they've got the S&P here, and they've got a liquidity index and that they track, and they do see a downswing in that coming, and that's likely to take the S&P lower with it as the Treasury refills its TGA. And quantitative tightening continues at the same pace. The idea is that quantitative tightening has been sterilized by the fact that the TGA has been drawn down so far this year. And so if that stops happening and now the TGA actually has to be replenished as well as QT continuing at the same pace, then that's quite a big liquidity drain. It's quite a big pivot. And they are estimating that in terms of nominal GDP drawdown, they're thinking 10% of GDP could be taken out. That's not a minus 10% on GDP, but 10% of the GDP. That could be taken down over the next 3 months due to this flip in the TGA dynamics, basically, right? So that's something we need to be wary of. If we then add to the mix this seasonality, you can see this box here of what June typically looks like on the S&P. Obviously, March to April, you normally get a rally, and then you start getting this consolidation in May and June. So June is historically going back, many years, 20 years. I think this thing goes back to look at seasonality, and we typically get a bit of a pullback in the S&P around June before then resuming the rally again. So we may well see that. Clearly, the stocks that have been leading the rally have been these AI names. They didn't exactly have the best session in the last 2 days. We saw Nvidia print highs of 420 on Tuesday. It's closed at 380. That means it's 10% off its intra-week highs already. So it's something to just be wary of, given that has been leading the rally. And then so far, US vols haven't really reacted to this reversal in prices from those intraday or intra-week highs, as Europe and China have really been in the spotlight because they've been having bigger downswings. But, you can't really, I don't think the US can ignore this downdraft in Chinese growth for too long, especially if there's no one left buying the US tech names, right? So it may well be that the US market, if there's no more strength in the AI space in the near term, and that needs a pullback, then we may well see US markets kind of catch up to what we're seeing in Europe and China. All right, what else? So looking at energy stocks. So obviously the sector XLE, one of the sectors that we track in our various sectors that we look at, it's been following oil prices lower due to economic data from China, obviously, which is the largest importer of oil, lower diesel demand in the US due to milder weather and the manufacturing slowdown that we're seeing. So a few things driving oil lower on the demand side. Now, OPEC Plus do have a meeting on the 4th of June, and prices have been in a steady downtrend, and we know that demand has been falling. But the Saudis have been talking about, squeezing the shorts or watching out on the shorts. So we do think they will likely attempt to cut production to support prices, and that might provide some short-term relief to crude prices. But the fact is that it's in response to weaker demand. So significant upside is going to be difficult to sustain because they're just cutting in response to the fact that the demand's not there and prices just keep collapsing. Okay, now we're not so sure about buying the dip in oil itself because, like we say, we think it might be short-lived. Now, if you look at XLE though, that is more a function. Obviously, it kind of follows and has been tracking what oil's doing, but it also cares about these crack spreads. Crack spreads, remember, are the spread between gasoline, diesel, and crude, which you have to basically break to make those things. Okay, now that has been not quite as low. If you look here, XLE retesting its year-to-date lows along with crude itself, but this level of crack spreads at around 31 is basically holding in better. So that may well mean that the profitability for these refiners holds in, and therefore XLE itself can maybe not do as badly as the oil price if the oil price does still have further downside, right? And with the oil futures still in contango, it does suggest that maybe there is still more downside in oil. Okay, so if I want to get long anything, it's probably XLE rather than oil itself. We are also seeing a technical retest of this kind of support area that has held back in March, down in the mid 70s on XLE. We are also seeing signs of momentum doing better, so that could, once we do get a green candle, that could be a positive bullish momentum divergence. So a few signs that it might be an okay opportunity to buy the dip in XLE. So looking at our vol dashboard, what's the options trade being suggested here? Well, we are in nearby calls, but bear in mind that positive vol carry means that buying outright calls isn't a no-brainer, and this is in the 90th percentile. So the realized on XLE just isn't there to back up these levels of vol at 28. Now the curve is inverted though. So if we look at June options in the high 20s, the curve does have an inversion to it. So for us, when we want to get long, we know the vol is relatively cheap in general, but it's not carrying, then that would steer us towards call calendar structures where we get long delta, but it's not like we're looking for some super sharp move to the upside, like, blowout to the upside. We're just looking for the trend to kind of resume back to the upside, but we are cognizant of the fact that the realized just isn't there and the curve is inverted. So we're happy to take advantage of the inverted curve and maybe buy some calendar spreads. So that's what we're looking at. All right, that's it for today, guys. Thanks a lot for listening. Catch you all tomorrow. Cheers.